Hello, in this presentation we will compare QuickBooks Online versus QuickBooks Desktop. Hello, in this presentation we will record a sales receipt and the related deposit within QuickBooks Online. Here we are in the QuickBooks Online dashboard. We will be continuing with the Get Great Guitars problem. We're going to enter a sales receipt and then the deposit for the sales receipts. To do that, we're going to select the plus icon on the right side, so it looks like an X now, and we're going to go to the customers over here. Now note the difference between a sales receipt, which is what we will be entering now, and an invoice. Invoice meaning that we will be receiving payment at some point in the future, as opposed to the sales receipt. That means that we're going to get payment at this point in time and deliver the goods, in this case the inventory, at the same point in time. You can imagine the sales receipt as an item, as a receipt that would be generated within a store, as opposed to the invoice, which would be something that we would then generate and expect to mail out and receive at a later time in terms of a check at a later time. So we will be selecting the sales receipt. So we have the sales receipt item. We're going to select the customer up top that we are going, so we're imagining we are making a sale. At this point in time, we can imagine the customer being in the store, picking up a guitar within the store. It's going to be an ELP, an Epiphone Les Paul guitar that they're going to pick up, and we are going to sell it to them at this point in time and record the payment at the same point in time. So we could select the drop down to find the customer and or type in the customer, which is going to be Garcia Guitar. This is going to be a new customer. Therefore, we will add the customer. It will be a new customer type. And I'm not going to put the details in at this time. We're just going to say save and move to the next item. We don't have an inventory or an email. If we did, we could send it by email, but we're typically thinking that this is going to happen within the store. We're going to give the sales receipt at this time. We're then going to have the billing address. Now, the billing address could be important if we sell inventory, remember, because it will be needed to calculate sales tax in many cases. So to calculate sales tax, QuickBooks will do it automatically, but it needs to know the location that we're at. It needs to know the billing location that will be there, and we need to input the sales tax information in terms of the who we owe sales tax to and set up those items. To see that, look at a prior presentation. Because this is a practice problem, we will be using a 5% sales tax, but in order to get that to calculate, what we're going to do is enter an address here. We're going to say that we have the address. This is just going to be an address that is in California, so it will then populate the sales tax. Then we're going to change the sales tax to 5%, just have a standard sales tax item. Remember that if you don't put this information in, the billing address, then it may not calculate the sales tax. It'll be something that you can't change. So for a problem like this, you have to basically set up sales tax, then enter something. You can't put the sales tax in the setup at this point because it does it automatically, but you can go back in and change it once it does the first primary calculation. So that's what we're going to do here, and we're going to tab through this. And we are going to say the date is on 02/12/21, February 12th, 2021. We are working in the future here. We're going to tab through this, and we're going to say the payment method. We're going to say we got a check. So here are the payment methods. We received a check at this point in time. Remember, we're making the sale at this point in time. The deposit is not going to go into the checking account right now. We instead are going to deposit it into an undeposited funds account, and then put it into the bank as we go to the bank at the end of the day, collecting all the checks we have, putting them into the bank in the same grouping so that it will match the grouping on the bank statement, and we can then tie out the bank reconciliations as needed. Then we're going to select the product, and it's going to be an ELP Epiphone Les Paul. So we could select the drop down to find that and or type in ELP. We'll tab through this. We're imagining that they brought the guitar up here, up to the store, up to the front, and this of course would be what would be the guitar name on the guitar, and the sticker price then would be given, in this case $500. So we're going to say that they bought one. Here's the description populating for us automatically because we have already entered the item. We have quantity 1, the rate is 500. Sales tax will be calculated. It's not calculated yet because we're still on the same line. So hopefully when we click down to the next line, it will calculate the sales tax. But it is checked, so it should do something. We're going to click on that next line and see that it should calculate something here. Now, it's calculating based on our location, the billing address, and what we have entered into the system in terms of who we owe sales tax to typically. And we're going to change that to flat 5%. So what we're going to do, just so it will be an example for any type of location, you can apply whatever rate is needed and or use QuickBooks to apply whatever rate is needed. So we're going to say 500 times 0.05, 5%, and we're going to say it's a $25 sales tax. So we're going to change this to 25 for our example problem purposes. It's going to say the system, QuickBooks says, hey, you know, that's not what we came up with. Do you want us to, did we do something wrong? And we're going to say, no, keep the changes, you're okay, and I'll tell them that it's an example problem so that everything is okay there. So we're saying that we billed 500, we had to charge sales tax of 25, 5% on the 500. That gives us a total of 525. So if we recap what is happening from this sales receipt, it is a sales receipt. That means we got payment, in this case cash, but the check not going into the bank yet, going into undeposited funds, still an asset account increasing by the full amount, which would be the 525 we are receiving in the form of a check. The other side will be going up, which will be sales. It's only going up by 500. That's the sticker price of the guitar that we sold. And then the difference between those two is, of course, the $25 sales tax, which will be increasing a liability for the sales tax that we owe in the future. Also, what is going to be recorded, which we cannot see here, is the cost of goods sold for this guitar that we sold and the related decrease in the inventory. We don't have those amounts, but we know that the inventory is going down by the cost, which means what we bought it for. We could find that if we looked at the item list in order to see what we paid for the guitar. QuickBooks knows what that is and is using a perpetual system. As we make this sales receipt, it will then decrease the inventory and record the related cost of goods sold. So we're going to go ahead and save this. We'll check to see that it does what we expect it to do. So saving it, we're going to close this out and see our financial statements and go through those components to see if it's done what we said it would do. We're going to say reports on the left side. We're going to type in the report first, the balance sheet. And there is the balance sheet. The dates on the balance sheet are going to be the second month, 02/01/21 to 02/28/21. Then we're going to run that report. So within the balance sheet, we know we got cash, but we didn't put it into the checking account. We put it into undeposited funds. So it's an asset account. It's got 825 in it. Selecting that item, we see the 525 here. If we select that item, then we see our sales receipt. We're going to close this back out. Check out the other side of this. We're going to go back up top and go back to our report. The other side typically we think of as sales on the other side. So we're going to go to the reports and we're going to go to the profit and loss, which is where the sales will be at. Profit and loss report. And we're going to change the dates to the month of February, 02/01/21 to 02/28/21. February 1st to February 28th. We are working in the year of 2021. Run that report. We then say the sales side, the 500 here, selecting that item. We note that we only see the 500 rather than the 525. If we select that item that is on the bottom here, that's how much we got, but 25 of it is not going to be kept by us. We're going to have to pay it to the state for the sales tax collected on the sales price of 500, the amount actually earned, the amount then reported as sales or revenue. Closing this back out, we're going to go back to the balance sheet now. So we're going to go to the reports once again, look for that 25, which will be on the balance sheet. So we're going to type in balance sheet once again, selecting the balance sheet, changing the dates to the month of February, 02/01/21 to 02/28/21, running that report. Then we're going to scroll down to the liabilities section. We want to go down to the California State Board of Equalization. That's our location that we're going to have to owe this to. In a lot of places it would be called, if it wasn't a lot of other programs, it might just be called sales tax payable or some type of payable taxes payable account, if that's what it is. This, of course, is giving us more detail in terms of who we owe that to. And so if we select this item and scroll down, we see the amounts here for this sale. These are the three amounts that should add up to it, the 25. If we select either one of these, we will scroll down. That's being generated from this 25 sales tax. Closing this back out, we're going to go back to the report up top. The other side of this, remember, was that the inventory is going down, even though we didn't see that inventory amount on the sales receipt. So if we go to the inventory, we know we sold inventory, so this must be going down. And we select the item of the inventory that we sold. It's going to be this sales receipt is what we're looking for the 400. So if we select that 400, then we don't see 400 anywhere on the sales receipt. We see 500. That's because the 400 is what we sold it for. It will be there in the amount on the item list. To see that, we can close this back out. Let's see where that 400 get there from. We're going to go to the sales items here. And then we're going to go to products and services up top. So we're on sales on the left side, products and services. If we scroll down, we're looking for, I think it was the ELP that we sold, 500 sales price, 400 cost. So the system knows it's a 400 cost, although we're not going to put that on the sales receipt because our customer doesn't need to know that cost amount. Then we're going to look at the other side of that. We're going to go to the reports one more time. We're going to go to the profit and loss. And we will change the dates once again to the month of February, 02, 01, 21 to 02, 28, 21, and run that report. The other side is cost of goods sold. So here's the 500 we got in revenue. We got 525, 500 of it was revenue to us. It cost us 400, so the net increase then, of course, is 100. Selecting this 400, there's the cost of goods sold for that guitar. Selecting that item, we once again have our sales receipt here. Closing this back out, we're going to now record the deposit. So we're going to scroll back up top. We're going to select this little plus icon. And you can think of the deposit usually as part of the customer section, although it is over here in the others section. Meaning what typically happens is we're going to invoice the customer and get a bank deposit in the mail, or we're going to create, as we did here, a sales receipt, get a bank deposit in the mail. The reason the deposit's not in the customer section is that there's a significant amount of times that we may not have that as the way we got the deposit, meaning we could have got a loan or possibly we put money into the system, so there's other types of transactions that can have a deposit, but hopefully the deposit most of the time is really part of the customer cycle, meaning we're billing the client, we're getting money, and we're depositing that money into the bank. So we're going to go ahead and record that deposit, and that's going to be the concept that we have here. We just got a sales receipt, and we recorded that into undeposited funds. We're going to group those sales receipts together with any other deposits we have not yet gone to the bank with yet, and then record those deposits at this time. So here are the deposits, checking account. We're going to make the deposits dated at 02/12. We're going to say 02/12/21. 02/12/21. So February 12th, the year we are working in, 2021. Here's the sales receipt we have. We're going to check that off. We're going to deposit that. We also have these other two that we had received these for, and we're going to deposit these as well. The two other sales receipts that had happened that we have not yet gone to the bank with, we're going to deposit them at the same time. So we're going to have a deposit then of 825, not just the 525, and therefore when we look at our bank statement, it's going to show a deposit of 825. That we can then match out to our books, which should be grouped in the same way at 825. So we're going to go ahead and save this. Once we do, however, let's make sure we know what's going on. It's going to go out of our checking account. So of course, it's going to go into our checking account because we are depositing into the checking account. And the other side will be the undeposited funds. These are all items that we got money from, typically a check or cash, and haven't gone to the bank with. So we put those into an account called undeposited funds so that we can record the other parts of the transaction, not yet putting it into the bank because we want to do that at one time, grouping them together as they will be grouped in the bank. So let's save this and see if it does what we expect it to do. We're going to close this back out. We're going to go back to the reports. I'm going to go to reports on the left side. We're going to type in the balance sheet. So balance sheet this time. We're going to change the dates from 020121 to 022821 and run that report. We will then check the checking account. That's where we deposited it this time, finally. Put it in the checking account. If we select that item, here's the $825 deposit that we have. Selecting that item will give us our deposit. Here's the $825 here. We will close this back out. I'm going to close this back out. We're going to go back to the balance sheet, so back to the report, which is the balance sheet, and see the other side of it, which is the undeposited funds. Note that QuickBooks is nice here in that there was activity in this account, so they didn't just make it zero. They didn't just take it away. They did make it zero and left it on the report so that we can see the detail. We can use this auto zoom function and say, yeah, I know it's zero, but what just happened to it? If we select that item, then we can see that we have the breakout. And notice that they broke it out here. They didn't just put the one deposit of the 800. They're saying here it was consisting of these items here. We deposited the 525, the 100, and the 200, which would give us, if we select any of those, the 100, the 200, the 525, or the 825 that was made as a deposit on the date February 12th. Hello, in this presentation we will be recording a sales receipt and deposit from a new customer within QuickBooks Pro 2018. If you've been following along with us, we will be continuing with the Get Great Guitars. If not, that's okay. We can follow along with the entering of the sales receipt and the deposit. We'll be covering what the sales receipt is, how to enter the sales receipt, and what the journal entry will look like, as well as the recording of the deposit, how it relates to the sales receipt, what will happen to the financial statements when that is done. If you have the backup up until this point, then you can restore that. Go into the file and restore. We're going to have the open windows open, so we're going to go to view, open windows here, and then have the open windows open. I'm actually going to close everything except for the home tab, so I'm going to close everything up. We have the home tab only open window. If you don't have the home tab open, it's in the customers, in the company and home tab. We're going to be working here in the customers section. What we have is the receipt of a sales receipt, which means that a customer is in the shop, we're selling guitars, purchased a guitar from the shop, we're going to get paid at the point in time of the sale, as opposed to when we have an invoice in which we bill the client and we expect payment in the future. So an invoice in our case, if we were to be selling guitars, may be more in the case of we shipped the guitars, the guitar went out, and we expect to receive payment in the mail, as opposed to if we're having a create sales receipt, we can imagine someone in the shop purchasing a guitar, and therefore we're going to create the sales receipt at that point. The journal entry recorded when we have the create invoice or the accounts affected would be that the receivable would go up, people would owe us money. The revenue would go up, we would record the sale. We would also have, if we're selling stuff, as we are here, selling merchandise, another half to that, one being the inventory going down for what we sold, in this case, guitar or guitar equipment. And then we're going to have the cost of goods sold on the income statement. When we have the sales receipt, only difference then is, of course, that we're going to be receiving payment in some form at that point, and therefore not increasing the receivable, the amount people owe us, but some form of payment, typically cash. So let's see what that looks like. We're going to create the sales receipt, and then we're going to record the deposit related to that sales receipt and any other deposits that we have at that point. Looks like there's two of them. So we're going to create sales receipt. And we're going to have a new customer. So if we select the drop down, we got Garcia Guitar, and it's not here at this point. So we're going to have to add that. Fastest way to add the customer would be just to type in customer name And then we're going to select tab, and it's going to ask us to add the customer. We're going to select tab, and it's going to say, do you want to add the customer? We don't have the customer in our list. We're going to say yes. We're going to add it with the quick add feature rather than the setup, meaning we are not going to put the address and the phone number and the contact information, which we would probably want to do if it was a customer that we wanted to get repeat business from. But for purposes of the sales receipt, we just need the name here, and that's what we're going to be working with at this time. We're going to keep the template we are using. We're going to say that it was a check that we received. That's the form of payment. The date's going to be 02/12/21. We will be working this problem within the future, so we're going to say February 12th, 2021. The sales number will populate on its own. Sold to Garcia Guitar. We don't have an address because we didn't populate the address within the customer field, so we're going to keep that as is. The check number, we're going to write 8541. Now that's not the check number for a check that we are writing. That's the check number of the check that we are receiving, and it's good to have the reference there. It's not required, but it's good to have. Then we're going to say the item that we sold, the guitar that we sold, was an ELP. If we select the drop down, we see it's going to be this item there. If we type it in, ELP, it should pull up, so there it is. And if we say tab, the description will appear. Tax, quantity, we're going to have one of those. The rate is going to be 500, therefore the amount 500. We do have sales tax, that at 5%. And that 5% is an example number. It's going to change from state to state. It's going to be an item that we have to set up to calculate the sales tax and make sure that that's set up within the preferences to calculate the sales tax if needed. And that will be our total amount. What will this do when we record it? We see the 500 will increase the amount that we received, in this case a check that has not yet been deposited, therefore increasing undeposited funds rather than the checking account. And the credit of that 500 is going to go to sales. There is going to be a second half of that, however, because we are selling inventory. That's going to be cost of goods sold and the related account decrease in inventory. Note too that the undeposited fund is going to be for 525. The sales amount will be for 500. The difference of 25 is what's going to be recorded in what is due in terms of a liability to the state for sales tax. Let's take a look at the cost. Where could we find that? Just to know where that could be found, note that it's not on the sales receipt because we don't want to show it to the customers. In order to see it, we can go to the lists up top and go to item lists. And if we find this item, this ELP right there, we then open that up. I'm going to go to items at the bottom, and we're going to edit item. And that will give us what the cost was. So it cost us 400. That 400 is not on the sales receipt. Only the sales price of 500 is. But we know that this computer will record that for us. After we record it, we can take a look and see what happened in terms of the cost of goods sold and the decrease in inventory related to that 400 amount. Closing this back out. We're back to our sales receipt. We're going to say save and close, and then we'll go and see what happens in terms of our financial statement. Save and close, and it's going to say you have changed the transaction. I'm going to say yes, we want to record that. And we're going to go to our balance sheet first. So let's go to the reports up top, scrolling down to company and financial, and then scrolling down to the balance sheet standard. We're going to change the date range, top left, customize the report. And it's going to be from 01/01/21 to 12/31/21. So January 1st, 2021 to December 31st, 2021. Okay. There is our items. We know that we received a check, but it didn't go into the checking account yet. It went into undeposited funds. So we're going to double click on undeposited funds and take a look at that. Here it is there. There's the 525. If we double click on that, there is the sales receipt that we have just generated. So that's for the full 525, including the sales tax. That's what we got the check for. If we close that out, let's go to the income statement side and see what the sales receipt was for, what the revenue was for. If we go to the reports, company and financial, profit and loss, and then change the dates from 01/01/17 to 12/31/21, I should say, not 17/21. So January 1st, 2021 to 12/31/2021, that being the year that we are working this problem in. In the merchandise sales, we should have an increase there from this transaction, from this sales receipt. Double-clicking or zooming in on that, we see the 500 there for the Garcia guitars. So it's only the 500. If we double-click on that, we're only taking the 500, not the added 25, although we received 525. That difference of 25 is going to be what is owed to the state. So we're going to close this back out, and we close this back out. Take a look at that. That's going to be on the balance sheet side. Go into the balance sheet, and then we're going to go to liabilities, where we have the sales tax payable. Double-clicking on sales tax payable. We see that 25 that we owe. Double-clicking on that 25, we see the amount, our same sales receipt, and that 25, the sales tax calculated on that sales receipt. We're then going to close this back out. Close this back out. Now let's take a look at the inventory item. So if we scroll back up to the top, we have the other current assets. We have the inventory item. If we double click on the inventory, we see the Garcia guitar here. There's the 400. If we double click on that, we see the sales receipt, and we don't see the 400 here. Why? Because that's going to be part of the cost that we're not going to put here, but it is recorded by QuickBooks on a perpetual inventory basis. Closing this back out. Now note that we do have some other items here that were entered in a date after this, so our dates are varied a bit. We're going a little bit back and forth in this problem. It is going to be an example problem, so we'll have to deal with that a little bit. We're going to close this back out, and then we'll go to the profit and loss and look at the other side of that piece. The inventory decreasing and the cost of goods sold, then the cost of the goods that we are selling, the expense related to the revenue that we are earning. Double clicking on that, we see Garcia guitars here. There's that 400 again. There's the other side of that. So this simple sales receipt actually has a lot going on. If you can understand what's going on with the sales receipt in terms of the financial statements, it's worth going back and forth and making sure you understand those relationships. Going to close this back out. Close this back out. We're going to go back to the home, and now we're going to make the deposit. Now we have 3 deposits that we need to make. Remember that when we recorded the create sales receipt, it put the amount of the checks in undeposited funds. Now we want to group those all into the same deposit that we will be making at the bank and deposit them at the same time. That's what we'll do now. We're going to say click the deposit. Now, since we have 3 deposits that we need to deposit, this window will pop up. If we had no deposits that were in undeposited funds that we need to deposit, then this window would not pop up, and we would only see the window behind. So in this case, we want to deposit these 3 checks. So I'm going to check all 3 of them out, and when we make the deposit, we're going to group them all together and deposit them into the bank at the same time. That then will group on the bank statement at an amount of $825, and will be the same grouping we will see on our books, therefore making it easier for us to reconcile the bank account at the end of the month. So we're going to say OK. There it is. There's the $825. We're in the checking account. That's the only checking account we have. If you have multiple checking accounts, you want to make sure you're in the correct one. We are going to make the deposit as of 02/12/21, and the deposit's going to be the deposit. That will be it. Once we record this, it's going to increase the checking account with a debit, or increase the checking account, and it's going to decrease the undeposited funds down to 0. So let's record that and check it out and see if that's what actually happens. So we're going to say save and close. And then we're going to go back to the balance sheet and see what is going on with the balance sheet. We know that the checking account here then should be going up. Double clicking on the checking account. Scrolling to the bottom, we see this deposit here. There's the $825 there. Double clicking on that, we see the deposit of $825. There's that amount. We're going to close this back out then. And close this back out. we don't see, note, the undeposited funds. It went away. Why? Because it went down to 0. That's what we wanted to happen, but if we want to verify and look at the activity in the undeposited funds, one way to do that would be to go to Lists at the top, go to the Chart of Accounts, and then look for that undeposited funds, and we'll look at the activity within it. So it's recorded as an other current asset, so it should be at the top. If we just double click on that line item within the lists, we'll see the activity. There it is. There's the deposit. There's the decrease in there's the deposit, which decreased the undeposited funds to 0. And if we double click on that, we should then see the sales receipt. If we close that back out, the deposit's actually right above it. Here's the deposit. There's the deposit. So they're both on the same date, and it looks like the deposit was put above the sales receipt, but they're both there. They're both on the same date. The sales receipt is an increase to the undeposited funds, and then the deposit is decreasing it back to 0. The way it was input here, we were at 0, then the deposit they recorded first, making it go negative in terms of the undeposited register, and then we had the sales receipt bringing it back to 0.